Good morning and welcome to our 20th webinar of 2026. That's from the Institute of Economic Affairs. So the IEA is an independent public policy think tank based in Nairobi. And we do research and convene public forums such as this to discuss key public affairs. Our goal in this is to be able to influence policy processes and therefore by extension, policy decisions and outcomes. So our bigger vision is to live in a country or in a society that is stable and prosperous because we believe that it's prosperity that will change the lives of people. So we work across 6 different programs, and just to mention, we have the Constitutional Law and Economics program, we have the Popular Economics program, have the PFM, Economic Regulation and Competition, and then International Trade and Development, and Futures and Foresight, who are the hosts of this webinar today. So we are glad you've joined us, and today we want to discuss on digital taxation. That's taxation of the digital economy, which is not a new thing. The objective of this webinar will just to create an understanding of taxation of the digital economy, because we understand that revenues are important for government to be able to provide public goods. So to help us understand this subject, we have a guest speaker who is CPA Daniel Kabiru, and he's a managing partner at UHW Kenya. Just to mention a few things about Daniel, he's a qualified CPA and a practicing member of ISPAC. He's also a member of the Associate of Chartered Certified Accountants, ACCA. He studied at DASTA a long time ago, and before joining UHY Kenya as a managing partner, he has worked with Deloitte. So he brings his experience in issues of audits and discussions around taxation in this discussion today. And I know that at the end of this, we will be enriched and be ready to discuss more of this, even as we wait for the finance bill, which some of you, if you've been keen, you've been able to notice that issues of digital taxation has always been featured in the finance bill and the Finance Act. Years past, taxation was just mostly about what we can see, and the physical presence, the economic physical presence of entities was the basis for taxation. But then there was digital transformation, and then the innovations changed how business operates, how they are done, where they have presence, and also it changed jobs where people are earning incomes. And for tax leaders or for people in taxation, this transformation created shifts in tax basis. And so we've had conversations around it. We have seen policies and laws to try to bring that into the tax needs. So today, Daniel will help us to understand this, and the outline of the discussion will be just first, he'll try to help us to understand what it means, or what it means to tax the digital economy or digital taxation, and then what approaches have different countries taken on this. And after that, now he gives us, he takes his focus back to Kenya and how that has evolved since we started to consider digital taxation or taxation of the digital economy. And so after we look at that, he'll give us an assessment now with the evolution from where we started around 2020 to where we are, what the current approach. He'll give an assessment and the challenges that are coming along with the evolution. And to just give us a better perspective, because digital taxation is not just something that's happening in Kenya, it's happening all over the world. He shares 3 case studies, that's the United Kingdom, India, and the European Union. And you see, that comes just after he has given us an assessment, focus on Kenya, and an assessment of how the current approach is organized. And after that, it will be very interesting, because after that, he will discuss now the key question of our discussion today. Is this an accelerator or a disruption? That is a roadblock to revenue for government. That's the taxation of digital economy. That's the important question that we want to answer today. And in his presentation, he wants to answer that question and finally give us key takeaways from the discussion. And once again, our chat facility is open for everyone to write in your comments, and importantly, the questions that cannot wait until the end. And after Mr. Daniel has made his presentation, we'll have a chance to ask our questions as well. That's in the plenary. So, Mr. Daniel, karibu sana. You have around 20 minutes to make your presentation, and our audience is very ready to listen to you. Karibu sana.
Thank you, Jairus. You can hear me?
I confirm we hear you well.
Okay, thank you very much. So it's a pleasure, as has been introduced. My name is CPA Daniel Kabiru. I work with UHY Kenya. We are based in Westlands. So it's a pleasure to do my presentation on this subject matter. Jairus, you can confirm that you can see my screen?
It's visible. Okay, you can go ahead.
That's okay. So thank you. So we are based in Westlands, and we are an audit firm, but we also offer consultancy services. So straight to the subject matter. As you've mentioned, that any government has a responsibility to undertake activities, and these activities require money. So from the time immemorial, government taxes its citizens so they are able to generate income. And one thing that is said is that if one thing that is very certain, number one is death, the other one is taxation. So on the issue of taxation, government puts in measures to ensure that they do generate taxes, and to for the projects that they do have to be able to undertake them. So historically, from the time we gain independence, government has put in measures and taxes. Even when the colonials were there was always taxes. So when the government came in, so they put in measures, and each and every year, as you are aware, the government puts in a finance bill, it goes through parliament, it's discussed, and these are measures for government to be able to generate more revenue. So I'll give you a small history of where we've come from, and this relates to what Jairus has mentioned about. Historically, taxations were for permanent establishments, what we call them Ps. So companies that have physical presence. But with the transitions, there are a lot of changes, and governments see this opportunity to be able to raise taxes. I'll take you back memory lane, and this is after independence. Government created a company called Kenatco, which was established in 1966. And this was a taxi company, and of course they had vehicles. So from 1963, they've been running the taxis, and of course, even individuals got into the business. I'll take you from 1963 to the late 1980s and early 1990s. If you recall, those who were there or who are old enough, there's what was called the London taxis, or better referred to as the Nile taxis. Also, for those who recall, they used to be parked around Hilton area, where you will get those taxis. And Hilton, and maybe those who are uptown at Intercontinental. I believe both establishments are now not in existence. That tells you how volatile at times the business can be. So back to the taxis businesses. So these were brought in and they did the businesses. They still went down. So if you recall again, earlier then there were now the taxis, what we used to refer to them as taxis. And you will find them mostly around Koinange Street. And I recall maybe 15 years ago, taking a taxi from town, that is Koinange Street, to Westlands was around 1,000. And then the fuel was give or take 90 shillings. And you will really have to negotiate to get maybe a taxi that will cost maybe 600 shillings. Now, come to the modern times. Fuel has doubled in price, so we are around 182 today. Of course, the cost of living has gone higher, but you can easily take a cab through the taxi hailing cabs, and you'll pay maybe 200 shillings. That tells you something. There's a lot that has changed with time. Now, the same thing has happened to governments, that during that time, where businesses were run by individuals, currently we have businesses that are online. And governments across the world have seen this as an opportunity to be able to raise taxes. And that's the discussion that we're having on digital taxes, that most of the businesses, and if you look at the big multinationals, look at the Airbnbs, look at the Bolt, look at the Ubers, these are large multinational companies. They do not have physical investments. They have made their businesses through technology. So government saw around the world that this is an opportunity to be able to raise taxes. And that's the reason why we are discussing today the topic of digital tax. So let me move to that. So what is digital tax? Digital tax is basically a tax on a digital platform by government. And this goes beyond the physical presence of any businesses. So what the governments try and do, and this has been the approach, is to ensure that taxes are paid based on the consumer and not the provider of services. So basically that's the background of digital taxes, and government have been trying to put in measures to be able to ensure that they're able to generate tax from this very lucrative industry. So there are two approaches which government have been putting. Number one is what we call unilateral digital services taxes. So this basically refers to countries acting alone to be able to generate income by what they see. So what you will be, if you recall, in 2021, government introduced what we call DST, Digital Services Taxes, and this was at a rate of 1.5% of the gross revenue that was generated. So, and during that time, government basically was focusing on foreign companies and local companies to be able to generate that revenues. And those companies, they're the ones who had physical presence in those countries. So, but however, due to the fact that most of these multinational companies do not have physical presence in the countries where they do sell the services, then we do have the OECD, which basically refers to an organization of economic cooperation and development, which is an intergovernmental bodies that is set up to ensure that companies and countries are able to generate their revenue, their equitable revenues from this multinational. That's why we have now what we call the multilateral approach. So the multilateral approach, basically what it means is that government set up policies where if one country charges taxes which are below what we refer to as a tax haven. What again, for tax planning purposes, most multinational companies, what they do is that they do set up their headquarters in these tax havens where they have very low taxes. And they ensure that they transfer most of their profits to this particular country so that they're able to enjoy lower tax rates. However, the multilateral approach, what it does set a minimum of 15% being the corporation tax that is chargeable. So if at all there's any country where these multinationals have set up and they do charge below the 15%, say 5%, then the consuming country will be able to receive the top up of the difference between the 15 and the 5%. So it's basically trying to level the field and to ensure that revenues are shared equitably between these two countries. Back to Kenya. So we are in 2020, and through the Finance Act of 2019-2020, it introduced, actually it was 2020-2021, it introduced the DST regulations, where it says that all the revenues that are generated for businesses that are established in Kenya, the PEs, then they will be charged a rate of 15%. And this is on the gross revenue. So, and the scope was basically on the digital market, and this excluded the cloud, the AI, the streaming softwares, and the licenses. So then the focus was, the nexus basically refers to the focus is on the type of transaction that I've mentioned. So one of the issues that we have is that most countries, especially Kenya, we have double taxation treaties or agreements with countries. So with the introduction of DST, then you will look at there is a conflict between what has been agreed, and these double taxation agreements are historical. So now comes this new animal that we are calling DST, that taxes based on the revenues and not recognition of the DST that are in place. Now, moving forward from 2021, then government, if you recall, the Finance Act, it was the bill of 2024, 2025. It was very contentious, and the president did not assent to it. However, on December 27th December 2024, tax amendment bill was introduced, and this introduced what we call the special economic presence tax. So what is the difference? The difference is that special economic presence tax, what we call SEPT, now focuses on the consumer, irrespective of if any of these companies has a permanent establishment, what we call a PE in Kenya. So the focus and currently what was introduced in Kenya is that it presumes that the profit before tax of these businesses is 10%, then it taxed at the current corporation tax of 30%. So the effective rate of the gross revenue is that there will be a tax of 3% on this gross revenue. And this now attracts the Netflix that we have, the Ubers, the cloud computing, and all these licenses. So what this now dictates is that irrespective of if you have presence in Kenya, as long as you do businesses with Kenya, then you are expected, one, to be registered as a taxpayer through agents. Then the agent is responsible for emitting this 30%. So the scope here has been expanded, unlike the previous one, which was just digital marketplaces. So here we are looking at cloud, we're looking at AI, we're looking at streaming, the Netflix, we're looking at data, educational, and anything that is transacted through the digital platform. So here is that you really did not require to have any office or physical presence in Kenya. As long as you have consumers in Kenya, then the government do expect that you're able and you have to pay your rightful shares. The other thing we look at on this is that it deems that irrespective of if you're making money or not, then you are deemed to be making revenue and profits, then that is taxed. So basically that gives a brief about where we are in terms of the current SEPT, which took effect from the 1st of January 2025. So we are actually now in the second year. So we do have a table that indicates, and this is an example. So if a company makes a total revenue in Kenya over 100 million, then it is presumed that the profit made from the 100 million is 10 million. Then this is taxed at a rate of 30%. So you expected to pay 3% of it, which is 3 million. And this is payable by 20th of the following month. So once you receive the revenue you expected to remit by 20th of the following month, just like we do pay for VAT. And this needs to be done, and the person responsible will be the agent. So all these multinational are expected to be having a local agent. So that one, the agent is the one who is responsible to ensure that the tax dues are paid. And if they're not, then they are personally responsible. So the issues that we have relating to the introduction of SEPT or the digital tax is previously, of course, there was the issue of permanent presence. But in the current period, what we look at is the consumer. The consumer is a determinant of if tax is due. So one of the things that OECD Pillar 1 tried to establish is that for all these multinationals, that at least there is a profit margin expected of 10%, and this should be realized with the countries who are the consumers. So one of the challenges we have in terms of is countries where the tax regime is not strong enough and you do not have strong agents, then how is it the government is able to know who is the consumer, who consumes, and what is paid? Because most of these payments, again, are done on digital platform. So the other challenges, the key issues that we have is on what we've discussed on the second pillars, where we do have 35 countries have signed into the OECD second pillar. And what it does, and also for all these countries who have signed, they are expected on annual basis, either a subsidiary or the parent company, as long as you do have a global revenue of above euros 750 million. Not too many countries, not too many companies in Kenya will have this, but as long as you're a subsidiary and your total revenue is of global revenues over 750, and you fall under OECD, then the parent company is expected to report. If the parent is not a member, if the country is not a member of OECD, then the subsidiary now has that responsibility of reporting on behalf of the parent. And this information is shared across the members so that they're able to review and analyze if they are making their respective share of taxes. So the other issue, again, I'd mentioned is the issues of where we have double taxation and the fragmented tax regimes for various countries and the compliance burden. One of the things that happen with double taxation treaties is most of them will indicate what are the benefits of those double taxation agreements. One will be they have concessionary tax rates. Number two, they also allow maybe the tax to be an allowed expense, or again, that tax expense that has been paid in one country can be offset in another country. However, with this tax regime, it now comes in and it overtakes what we have with the double taxation agreements that we've had with the country. So that's one of the third challenge that we have. So if we now analyze the critical assessments of the SEPT, is that it presumes, irrespective of if a country is, if a company is making profit or not, that you do have a profit before tax, what we call deemed profit. It's presumed tax of 10%, then you are taxed at 30%. So you actually pay, irrespective of if you're making money, of 3% of the total. So again, and especially this is for firms which are small or are in their early stages, where in most cases, businesses are not making profit, then you are expected to pay taxes, irrespective of if you're making money. The next issue is what I've mentioned on the issues of double taxation remain unresolved on how do you treat these DTAs that have already been signed. The other issue that we have is in the Finance Act of 2025, the threshold of 5 million was removed. So meaning irrespective of if you're a small company, then you are expected to be able to pay the SEPT taxes. So that again becomes a barrier for people who are new or trying to enter the innovation space. So the other key challenges, and I've mentioned, is that as long as you have consumers in Kenya, you're expected to have agents and financial institutes who are now responsible for making your payments in Kenya. So again, this looks at enforcement. If at all payments are not done, then KRA will come after your agents, being the ones who are responsible for making those taxes. Then the third issue is global retaliatory tariffs across mostly geopolitical exposures. And here we're looking at most of these companies are US based, and of course they do have financial muscle. So what the US does is that they do have various treaties and agreements with various countries. So they are able to pull that plug and tell you that these taxes that you're introducing are not very beneficial to our companies. So they will be able to push back on these particular rates because basically it's affecting most of the tech companies in their respective countries. So the final issue that we do have is that regulations are in place. Then we do expect that there will be public participation in place. And that was done in September of 2025, but we do not have a regulation that has been signed. So those are the challenges that we do have with the SEPT. So examples of where we are. So there are countries, and this is the UK, who've already do levy 2% digital taxes tax for the large companies. And from from the years 2022 to 2023, it is estimated that the UK received a total of GBP 350 million. So these are countries who've gone ahead and they can see the benefits in place. Then we also have India, who have also been introducing and have had digital taxes. And this started in 2022, where they introduced a 2% levy, and they've been able to generate revenues. Then again in August of 2024, then they also expanded it to e-commerce. Initially, just like Kenya, it just focused on the digital market. But again, with the emerging traffic and businesses on e-commerce, then they've been able to expand it. So the next country or block we're looking at is what we've discussed on pillar number 2, where the policies is to ensure that irrespective of which country these multinationals have their headquarters, that as long as the consumers are there, they will be able to get their fair share. So this is in transition, and there are few countries that have started within the European Union who've started the early adoption. So those are the experiences that we have with the digital platform. So on the issues and the big question that we're asking, is it an accelerator or roadblocks? So number one is that, as we are aware, is that for any tax, they do have any tax regime, their responsibility is on annual basis is to ensure that they generate enough taxes from the business so that they're able to implement the plans and the programs they do have for that countries. So it is a platform where government can leverage and be able to gain more taxes. So the other issue here is that as an accelerator, and especially for third world countries, there's an issue of tax shifting, where what this tries and cures it to ensure that irrespective of which country you are, and the consumers are, they're able to get their equitable and fair share of the profits. The other benefits that we have, once these multilateral frameworks are put in place, and they do not depend on what we can refer to as on the local finance bill and act, which are enacted on annual basis, that if we go as per the OECD pillar number 2, then there is certainty on how countries are going to implement it and to collect taxes. Now, on the issues of roadblocks or the disadvantages of having it, one is the issue of compliance cost. As you are aware, compliance is a cost that is levied on the companies, on the local companies. So for companies that are not multinational, so this we are referring to the small and medium-sized firms, there is an additional cost that they have in compliance. The next challenge is innovation risks, as I've mentioned, that this again presumes that irrespective of any company, even if you're not making profit, then there is an additional cost on tax. So this might hinder innovations, especially for startups company. I've mentioned on the issues of double taxation, where there is now a conflict between what we have, the DSTs, the SEPT, and the double taxation agreements that have been signed. Most of them were signed in the 70s, 80s, and maybe some later. They did not anticipate that we will have this. So that gap has not been introduced. The next one is on the trade friction. As you are aware, with the Trump regime, they become very aggressive with the issues of signing tax tariffs to various countries. So they can use this to bully the smaller economies where you're trying to implement maybe Pillar 2, but then it affects who is the main company, the country affected. These are companies that are in the US. So it brings in friction between the US and the various countries. So in conclusion, we are saying that digital taxation is inevitable. Fact that now we do have this as a business, so government are live to the fact that this is an opportunity for them to be able to raise taxes. Number two is that there is pillar number 2 on OECD, which again, the model is to ensure that we do have a 15% minimal global rate that is effective irrespective of where you are. So for any countries where the consumers are able to benefit from this, then there is the issue of now the increase of the tariff. Before the rate was 15, it's increased to 13 and to 3%. Number two, the scope has increased. As long as you're doing business on the platform, then government expects to be able to get taxes from it. So the next issue is that with the DTAs, again, we know there are the issues of how to implement it, and these issues remained to be resolved by various countries so that they ensure that, one, they are alive to the fact that DTAs were signed, and these are expected to be implemented, but we also have this animal that has come, and it was not anticipated. So those are the key issues that I like to discuss with the team. And I will take it back to the host for any reaction or any question. Thank you.
Okay, thank you, CPA Daniel, for that presentation. You've covered a lot of things and even given us some history of taxes. And you even mentioned how we had cheaper fuel and very expensive or costly taxi services. And now I think we have the Ubers, and even cheaper compared to that time. And so you started by reminding us of the responsibilities of government and why they have to look for money, including borrowing and taxes. And you reminded me that actually the Institute of Economic Affairs has has come up with a debt counter showing how much government is borrowing per day, per second. And it's on our website. I hope we'll be able to interact with it. And you've given us the evolution of digital taxation from the digital services tax to now SEPT. And in your takeaways, you've shown us that I think the third point, we've moved from 1.5, which was lower, to 1.3 to 3%. And one thing that was a key takeaway for me was that big assumption that you are making on profits. If you are doing business, the assumption that taxpayers make is that at least you're making some 10%, and we are basing our tax rates on that. And you explained how that becomes a challenge to startups and how actually that impacts on innovation. You also, you've several times, repeatedly, you've come to this issue of double taxation agreements. And lastly, you mentioned that they're actually old. And I think tying that to the Trump, that brings in the strength of countries, the economic power the country, different countries come to on the negotiating table, and how that might also be a factor in reviews that might come to this. So without going into much and repeating what you said, I know our audience would love to ask their questions. And now I think our microphones have now been enabled. So anyone who wants to ask a question? But as you prepare to raise up your hand and ask your questions, I have two questions on the chat for Superior Daniel. They're from Fiona Okadia, and Fiona asks, how will the government realistically enforce SEPT on foreign companies with no physical presence in Kenya? And that is, you have mentioned tax agents, but what if the companies do not appoint any? So the question again is, it's on the Q&A. How will the government realistically enforce SEPT on foreign companies with no physical presence in Kenya? And that's because that's coming from the fact that you mentioned that they have to have tax agents, but what if those companies have not appointed any? The other question is, could governments be overestimating how much revenue digital taxes can actually generate? Could government be overestimating how much revenue digital taxes can generate? Because there's that shift now from permanent establishments to digital economy. And now, because tax government could look at that as a big opportunity for revenue. And so Fiona asks, could government be overestimating how much revenue digital taxes can actually generate?
Okay.
And finally, I think the third one, if you can answer this together, there's another question from Stephen Jairo. And the question is, one of the best practices of taxation is that taxation should be simple and enforceable, and should not dampen investment and competition. So the question is, what would you suggest as the best way or model to ensure that those in the gig economy are onboarded with the limited interference? That one of the best practices of taxation is that taxation should be simple and enforceable, and should also not dampen investment and competition. What would you suggest as the best way or model to ensure that those in the gig economy are onboarded with limited interference? Over to you, Spear Daniel.
Okay.
And then we'll come back to another second round of questions.
Okay, thank you, Jairus. Now, on the first one it's a huge challenge, especially for government. If you're dealing with most multinationals will try and have some level of compliance. However, if you're looking at small and medium, where you do have a developer, say in India, and it's a one-on-one arrangement. So you agree on the fees, you agree on the payments, they do develop the software. So from that angle, it might become a bit difficult, but however, there is a catch. Having thought about it, as I'm discussing it, there's something that government now has enforced, and it's called e-teams. What does e-teams expect? It does expect that for all local companies, if you're providing a service, you have to be able to raise an e-teams compliant invoice or receipt. Number two, which is again very critical, is that if you're the consumer of that services, meaning you pay for that services, that expenditure need to be ETIMS compliant, and it needs to sit on your iTax platform. One of the things that I am aware, and it's a very kind issue, is that for anyone who tried to file returns last week, there was a challenge. iTax was prompting you and telling you that we do not have this number of expenditure that sits on their platform. So I heard today on radio that has been through the commissioner. He mentioned that they've relaxed that and people are able to do that. But one of the things that I foresee is that come 2026, for anyone who will be filing, they will be expecting that all expenditure should be able to sit on the platform. So if you have this expenditure that does not sit on the platform, and you made a payment to a foreign company, then what that means is that the entire expenditure will be disallowed. So now you have a catch 2022, is that you'll need then, for you to be allowed, you need to indicate that, yes, I received a service from a multinational company and or any foreign company, and this is the expenditure. Then they will expect that there should have been taxes raised. So I'm thinking that could be the only way, but as it is a challenge because, I mean, government does not know what you're doing in this commercial transaction between different parties. But thinking about it, maybe ETIMS might be one of the ways that they might try and enforce it. On the issues of government looking at overestimating how much they are able to generate from SEPT, I think one of the key items that we have is that once OECD Pillar 2 is able to be enforced, there will be a level of compliance because there is transparency between the various countries where you're able to see how much each of these multinational, again, I mentioned the threshold, are making. Then you can be able to see what revenue share that you have. Again, I'll give a historic perspective of when this, and especially the tax hailing apps came into Kenya. And the Revenue Authority looked and saw an opportunity where these multinationals, of course, they make a lot of money from the country. However, that revenue does not sit in Kenya. So once you make that payment, the commission which they charge, ranging from maybe 20 to 25%, it goes directly to their countries, and it is not funds that are for Kenya. So, and what most of them have done, even the ones who have permanent establishments in Kenya, they do have a support and a marketing office in Kenya. So these are not, they do not provide services. So what the taxman initially thought is that looking at the revenue that these multinational companies made, they tried and chased the VAT aspect. However, that was a huge challenge because VAT is paid by the provider of the service, and these are taxi drivers. So what these apps do is they provide a link between the buyer and the seller. So for them, they're not providing the services. So when Kerry tried to push back and tell that these multinationals that you need to pay the effective taxes, they said, we do not provide the services. If you need to follow up with the taxes has to be paid by the drivers. Now, there's a threshold that for anyone to register for VAT, either voluntary, you can do that, but as long as you hit a threshold of 5 million, then you are expected by law, by the VAT Act, to register. So at this point, when KRA looked at the drivers, of course, most of them, do not hit that threshold. So they're not able to collect that. So one of the hindrances, which is true, is that one, they thought the revenue does not sit in Kenya. So the most now the government is trying to push is to collect on SEPT, the VAT. Again, was a challenge because who is the seller of those products? They do not reach that threshold. So I think it's something that we'll need to watch. But with the compliance, I haven't looked at the data of how much they've been able to collect. But I believe because this started to take effect on 1st January 20, the 1st January 2025, maybe we'll be able to see that data and see how much government has been able to collect from that. On the other issue from Steve is on the issue where they're saying tax need to be simple, enforceable, and it needs not to be an hindrance. I cannot agree more. And the simplicity I look at it is on the issues of 3% of your turnover. Of course, I'd mentioned on the issues of now compliance, there's a cost for it. And again, for small businesses who are trying to penetrate, again, it's an additional cost that might be a challenge as you try to implement. So simplicity, I think, maybe it's not too complicated. Enforceability, again, is a challenge. Does it spur economic growth? It's a debate we need to have. Government might be collecting, maybe easier for multinational, because of course with the issues of high level of compliance, they do not want to have any issues with the tax regime. So there, the compliance will be high, but for small and medium-sized company might be a challenge. I think I've addressed the questions. Back to the session chair.
Okay, thanks. Thanks a lot for the responses on that. I hope that has been sufficient. So I still don't see a hand, but there's another question in the chat. And that's from Rafael Muya. And Rafael asks, generally, what safeguards should be in place to ensure digital taxes do not disproportionately burden small firms? Just share your ideas, some insights on that. That is on safeguards that should be in place to ensure digital taxes do not disproportionately burden small firms. I think you've touched on that, but it will be important if you go back to that again. And this is very important because you also mentioned actually that it punishes capital intensive, and then it will be actually a bigger burden on small startups. So that one plus there's one here. That goes back to earlier in your presentation on the approach. So we have this an approach where countries go alone, and where we have the multilateral approach. So I would love to understand which one is better, because I think there are different risks that come with each, and especially or especially on where the country goes alone, because actually most of these, some of these business that we are targeting on these are multilateral or MNCs or countries that are registered outside the country. The other, and okay, so I'd love to understand what will be the best approach, like, because I know for countries in the EU or countries like Singapore maybe would prefer the multilateral approach, but which one would be better for Kenya, a small economy? And lastly, If you look from 2019, when this was now coming up until now, we've had very many changes. We have the DST and now to SEPT. And then I think along this time, we've had delays in regulations. So we come up with this. We have it in the finance bill, tax amendment acts, as you mentioned. So we could have changes even within months. And then regulations for the same maybe would delay. So maybe if you are speaking to a government official on the same, somebody from the treasury, what would be your best advice to them? That we have these regular changes on these DSTs, on these digital taxation, and then we have regulations that take time to come up, and how that affects taxation of the digital economy. So please take the three.
Okay. Now, one of the things that government does is it transfers the burden of collection to you, the taxpayer. So look at all the taxes from pay to VAT to, the burden of collection. So what that means is that one, you either need to have an accountant in place, an in-house accountant, or you need to have an external accountant. And that's where we come in. We do provide that services. So and we are happy from that angle. However, it comes at a cost for any businesses. So what this does is the fact that non-compliance is expensive. Immediately, I look at example, if you delay in paying VAT, there's a 10% that is levied immediately. Then again, there's a 5% penalty on late payment. Then there's interest and everything. So non-compliance is expensive. So in terms of safeguard, I do not see with the current tax, the way it is implemented, is that it really burdens for the businesses. And it's become even more complicated, and especially if you look at compliance of maybe withholding tax. From the day you pay your supplier, you're expected to pay within 5 days. Again, that is a cost that is incurred. So as it is, maybe the taxman needs to think about a way that compliance cannot be too expensive. However, I do not see any safeguard in place because what the current regime does is that all, irrespective of which business, now you're expected to raise items. It is an additional cost. So for the very small and the micro mini companies, then you expected as the purchaser of these services, then you do reverse invoicing. Again, this is an additional cost. So in terms of where we are, I do not see safeguards in place. In fact, it's getting worse. You've asked the question on the issues of unilateral versus multilateral. So currently, the regime that we have is basically unilateral, where we're putting in place government through Treasury to ensure that they are able to collect their tax due from these digital service providers. However, we are also a member of OECD, and the advantages we have is just to be able to capture the policies. And the fact is, we do not have too many companies, and I've mentioned locally that will have a threshold of over 750 million euros. However, there will be multinational that will have, so we're able to tap into that. I would like to just see maybe from the data, maybe from the taxman, how much from those countries we've been able to receive the top up. Because the top up basically means that if the tax rate in the respective country is below 15%, or it's anything below 15%, then say for example, Kenya will be able to receive. Yet to see that, but maybe in future we will be able to enjoy those benefits. You've asked a question, and this again, the issue of digital tax is an animal that is live. It keeps transforming. So government, as these platforms and these innovations come in place, um, they put in measures to try and be able to collect more taxes. As you mentioned, of course, it started in 2019. DST was introduced. Then 2025 SEPT is. So we are now transitioning to OECD pillar number 2. So there is, again, measures from global perspective to try and collect these taxes from local. So what will I advise is basically to leverage on maybe what other countries, of course, I mentioned I gave examples of the 3 countries, is see what works in which jurisdiction and try and implement it. And again, I'll go back to the example that we have on eTIMS. We are not the first countries to implement it. Some countries have always been implementing it before us. So we try and borrow from what they have. Some were doing it piecemeal. For a government went full throttle. I'm here to see what transition, but basically is to borrow from those who are ahead of us. Back to Chair Jailas.
Thank you, Spear Daniel. I hope they borrow the good stuff only and not what will hurt our economy more. And I like your response because you also connected that could connect to what Fiona had asked. And actually, it will be interesting to see how much we've collected on the same, and because that's government revenue. There's one last question, I hope the last, from Nathan Kipchumba. Nathan Kipchumba, thank you for being here and for your question. Nathan Kipchumba, who is a second-year student at Kaimos University, studying Bachelor of Science in Economics and Statistics, has 2 questions. Which income are exempted from the digital service tax? That's in the chart. That which income are exempted from the digital service tax? And does the digital tax apply to the selling of physical properties by websites online? That if you're selling stuff on online on websites, does that affect, does digital tax apply? So those are 2 questions from Nathan Kipchumba.
Okay, then that's okay. So I'll go to my slide, and thank you for that question. Is that, let me expand this. So what SEPT does, unlike DST, is that it did expand the digital tax. I'm trying to think if there's any digital services that is not tagged on top of my head, no? So if you look at what we indicate as scope, the DST was basically focusing on digital marketplace, but currently all internet delivered services, including cloud, whatever it is. So I do not foresee, or on top of my head, see any exemption that we have from that perspective. So from where I sit, they are all taxed. So the next question, let me get it on the slide. If it applies to selling of physical properties via website and online, my quick question will be, fact that you're selling a physical property, it means that you're using this as a way of advertising. So if you put an advertisement on the website that we are selling this property, where I would look at it as an indirect tax to it is that if you're placing an advertisement and you're paying the website, then the website needs to declare that income and it will pay its due share. However, on the physical property, then that's a different transaction. So if you're selling a property, this will fall under capital gain tax. So that will be taxed separately. Where it will come in is if you're paying a website developer to host or put your adverts, then of course you pay revenue. Because again, on the issues of now enforcement, there's e-teams, then that e-teams will now need to be taxed. So that's how I will look at selling physical property being directly charged, but not under SEPT. Because SEPT will now mean the 3%. That would be my interpretation.
Thank you for that response. I think there's still more engagement on this, and so we have Evans Couple. Thanks, Evans. And Evans says, thanks, Dan. That was very insightful. I hope I'm not out of the topic. And then he asks that, is withholding tax on dividends and government securities final tax? And can it be netted off personal or business in one tax? That is for income and out of country where it's already taxed. How does it impact personal tax back home? That is on the Q&A. So the question is, but I hope, yeah, this is an important question, and I hope you'll give it attention, even if it's outside the scope. That is withholding tax on dividends and government securities final tax, and can it be netted off personal or business in one tax? And that is on for income and out of country where it's already taxed. How does it impact personal tax back home?
Okay. Good question. It's out of topic, but I believe I'm able to do justice to the question. It's something that we deal with. Now, dividend is either final or not final tax, and these are the two factors, two critical factors. Number one, for individuals, and in tax, we do have what we call a person, and a person can be a company or an individual. An individual is living person. So for dividends to individuals, and dividends here, you're looking at from profits. Dividend, basically, it's company makes money, then it distributes its dividends. So for individual, it is final tax, and it's usually at 5%. Now, when dividend is paid to companies, this again now a bit complicated. If a company owes another company and their shareholding is over 12.5%, it is not subjected to dividend, and it's not even expected to be withheld dividend. However, if you own a company, or one company, company A, receives dividends from company B and the shareholding is below 12.5%, the 5% will be withheld. It is not final tax. They have to pay the remainder of the 25% as tax. So that is the rule. There was a question asked on withholding. Withholding, again, there was a question asked on bonds. Now, there are two types of bonds. There is the infrastructure bonds and the normal bonds that we have. So for infrastructure bonds, for anyone who's been following, it's usually exempt of tax. So that any company that receives it, any individual that receives it, is final tax. However, for the bonds, other bonds, then government usually withholds 5%. So again, follow the same. For individual, it's final. For company, it's not. So it follows the same thinking, that withholding, individual final, companies, now you need to consider, is it infrastructure bond? What shareholding does the company have? There's a question asked on tax withheld for countries outside Kenya. Again, we've mentioned slightly on this, the issue of DTA, double taxation agreements. Double taxation agreements, and it's usually for various countries, Kenya with another country. So those DTAs will indicate and dictate how you're supposed to treat these particular taxes that have been paid in your country. Either you expense them or you can offset them as part of the taxes. So that one it will be dictated by the different DTAs that we have. However, generally, if again, from the tax, what it says, if you are a resident in Kenya and you are in the country between 183 days or within the last 3 years, 123 days, then as long as you pass through the Kenyan airspace, then your tax is due in Kenya if you are a resident. So this again applies that if you're receiving, and this is in terms of implementation is another thing, but the law is the law. The law states that as long as you pass in Kenyan space, then you need to declare your global taxes. Then that particular taxes that you paid in that country becomes an expense. Then you now subject that to because if you are an individual, then you subject it to the normal graduated PAYE rates. So that is the expectation that yes, you bring it, your global, and you have the tax as an expense. It is not an offset of the tax, but it is an expenditure. It's similar to an expenditure that you have. Then it's subjected to tax. Back to Jailus. I think I've answered the question. It had various parts. I don't know if I've done
Yes,
justice to the question.
thank you. Thank you for responding to that. I know it was off topic. And if Evans, you still want more clarification on that, I hope you can reach out so that we connect you to Spear Daniel. So we've come to the end, and thanks for everyone who set aside their time to join this discussion. For engagement, we don't take it for granted. Thank you. And thanks a lot, CPA Daniel Kabiru, for this engaging, important conversation. I hope that it will enrich even our discussions on the finance bill and government revenue that will be coming in a few months or weeks. And I hope that I know just before we I think you'll also as you make your concluding remarks, and I hope that Winnie is here and would like to say something before you conclude or after. So I hope that all questions are answered well. And on Stephen Gyro, the question on your suggestion on the gig economy, I'm sure you'll, okay, if there's something missing on this, I hope you can make, you can respond to it as you make your conclusions. And that was what would you suggest as the best way or model to ensure that those in the gig economy are onboarded with limited interference. I hope Stephen is, if not satisfied, you can make maybe one last response on that as you make your concluding remarks. So to you, CPA Daniel, for your last words, and then to Winnie to sum it up for us.
Okay, then that's okay. It's we're in very interesting times. Currently, what I can generally mention that we are in, and again, government is now leveraging on digital. So what it is expect you and me and everyone else out there needs to be tax compliant. As long as you're doing business, you need to be tax compliant. Number two, even if you are a consumer of services and you need to do report, then you need to be tax compliant. And one of the key maybe takeaways I can, in terms of compliance, is for all individuals or any companies that are doing trade, is that now you need to ensure that for all expenditure, you have e-Teams compliance receipts. And what happens is that on monthly basis or anytime you open your iTax, the table that there's the platform that you were able to see, you see all the expenditure that you've been incurring for that particular month. So what the taxman, I think, foresees going forward is that the taxman from their desk will be able to sit down and do your tax computation. They will look at your revenue, they look at all your expenditure, and they're saying that these are the expenditure that we expect. How practical that is a story for another day, because of course the expenditure. You take matatu, you hire somebody to come and clean the office and everything. So I don't know how that's going to work. However, on the last item of maybe the person who cleans the offices, then you're expected to do reverse invoicing. So the issues of compliance is it's now getting more expensive. We expect to be now compliant. And this again to anybody who the geeks who are in the digital economy. So if at all their clients who you provide services, they will expect tax compliance invoices and receipts. So what does that mean? You will have a revenue. So you also need to have expenditure so that you're not exposed. So if you do not have expenditure, then it means your top line is taxed at 30%. So that would be my takeaway from this, is that we are heading here, but we also need to be tax savvy and understand on how we can avoid and avoid is allowed and not to evade taxes. You avoid taxes by ensuring that you have legitimate expenditure that relates to your income. So that will be my takeaway. So I'll hand it to Winnie, maybe for closing. And thank you very much for the opportunity. I'm available for contact through the Institute. Thank you very much. And it's already afternoon. Have a good afternoon and a week ahead. Thank you.
All right. So thank you so much, Daniel, for making time to join us and for the insightful presentation that you've made to us. It's very clear that, like you have said, digital taxation is a reality. Good and you've gone further to give us even case studies of what is happening across different spaces. So it's just up to us as a nation, or it's up to those in charge of that area to just be careful on the direction they choose to take, because based off your presentation, the direction is what will determine whether digital taxation will become an accelerator or a revenue roadblock. So we really, truly appreciate you making time to make this presentation to us. And I would also want to take an opportunity to say a big thank you to everybody who's made a point to join this conversation. It's been pretty engaging. Your questions have been very insightful as well, and have given Daniel an opportunity to go deeper into a few areas where you had queries. So we want to say thank you to all of us. The team at the IEA who have also worked together to make this possible. We do not take it for granted. And to also remind you that the Institute of Economic Affairs is a membership organization. And if you would wish to join us as members, please reach out to our communications team, and they will be more than glad to take you through and allow you to become members of the Institute. That said, we encourage you to keep looking out on our our website and our social media pages for upcoming webinars. We still have a few more lined up this week and next week. So please be on the lookout for areas of your interest. And if you think there's an area that we as the Institute could weigh in on, please reach out to us on email, or if you have a contact to any specifics at the IEA, please reach out to them, and we will be more than glad to hold a forum where we can engage and just see how best to elevate your knowledge on those areas. So that said, asanteni sana for making time, and we wish you a lovely, beautiful, and blessed afternoon. Do enjoy the rest of your days. Asante.